Thanks everyone for joining us. My name is Celeste. I'm a reporter at 9fin. We have a great webinar for you today with some phenomenal experts. The webinar is done with DealCatalyst, who is hosting an SRT conference on October 6th in New York. And if you haven't already signed up, it'd be great to see you there. Today, we're going to delve into somewhat of a perennial topic of SRTs and US regional banks. More specifically, we're asking why SRTs should still appeal to regional banks and perhaps whether they ever appealed in the first place. We're going to reflect on whether this is the right lens to be thinking about regional bank balance sheets and how things are changing. If you have any questions, feel free to drop them in the chat as we go, and we'll try to get to most of them in the end. Now I'm going to let our speakers introduce themselves, starting with Darren, please.
Thanks, Celeste. Good morning, everyone. My name is Darren King. I work in the capital markets group at Merchants Capital, which is an arm of Merchants Bank in Indiana, a $20 billion bank based in the Midwest. We focus on mostly commercial real estate in the multifamily and healthcare space, and my role is executing securitizations, SRT transactions, as well as general balance sheet management and optimization.
Gareth, please.
Hello, I'm Gareth Hold. I'm a partner with Clifford Chance in New York. We have been very active in the credit risk transfer market in the US for many years, including working with a number of regional banks, starting with Texas Capital in 2019, 2020, through Western Alliance and PacWest, with Darren and the team at Merchants Bank, and also Valley and a number of other regional banks. We also work with a number of the larger banks and also with investors sort of putting this together. So I think we have a reasonably good perspective on activity in the US market.
Thanks. Liz?
Hi, I'm Liz Mazer. I'm with EJF Capital. We are an alternative asset manager that is financials focused based out of Washington, D.C. We focus really across the capital stack of predominantly regional and community banks. And serve as a capital provider really across the entire capital stack for them, and have been pretty active of late in the CRT, credit risk transfer, synthetic risk transfer, DRT, whatever alphabet soup you want to call this, for effectively balance sheet management trades for regional banks and community banks.
Thanks. And David?
Hey, good morning. I'm David Sklar. I sit in the global markets business at Bank of America, and I run the consumer and residential credit trading business, part of Securitas Products. I also am very involved in our SRT effort, particularly focused on third-party banks, as well as working with our own bank. And we will help banks do everything from whole loan sales to forward flow to balance sheet optimizations, including all sorts of capital relief trades in SRT.
Thanks. And Frank?
Hi, my name is Frank Benamou. I'm a portfolio manager at Cheney Capital. So Cheney Capital is a 13 billion alternative credit asset manager based in headquartered in London. So I focus on everything around SRT, risk transfer in general. And before that, I was co-leading and helped to set up the whole Barclays SRT platform.
Great, thank you. Before we jump in, actually, I think it would be good to kind of define SRT for the purposes here. Maybe, Gareth, you can kind of just start us off with somewhat of a brief description of the asset class.
Sure. So SRT generally is considered to be transactions that fall within originally the synthetic securitization framework within Reg Q. These was a group of transactions that essentially would synthetically create a credit risk transfer for banks using tranched guarantees or credit derivatives, and allow banks then to recognize the risk weight of a credit risk mitigant on the protected tranche, and also to take the benefit of a reduced risk weight on the retained exposure, which would be treated as a securitization exposure for capital purposes. So by executing those transactions, the bank was able to effectively de-recognize the assets that were subject to the synthetic securitization transaction, and instead recognize exposure to the collateral or counterparty risk on whoever was selling the credit protection, plus the securitization exposure on the retained slice. That definition has now morphed a little bit. I think, as Liz was pointing out, there are now many different flavors, including there are some cash-funded transactions that I think we still think of as being CRT transactions. And I think particularly EJF's been very involved in some of these, where there is actually a physical transfer of assets, but still a significant retained exposure by the bank. Effectively, you are still using the ability to transform the asset that the bank is recognizing into a securitization exposure, and therefore to take the benefit of the significant improvement in capital position as a result of that transaction. So broadly speaking, I think that in the US market, at least, we think of CRT, credit risk transfer transactions, as being primarily transactions that are executed for credit portfolio management purposes, where the bank retains a very significant relationship with the borrowers, often done on assets that are harder to move or to utilize in other ways. Not always for capital purposes. Many times they're being done for concentration limit or other purposes in risk management. But they all have this sort of flavor that the bank is largely entering into a long-term relationship with a protection seller for the improvement of their overall risk position.
Thank you. And some of those kind of different nuances we'll get into later, but at somewhat of a high level, I'd like to kind of also set the stage in terms of what the state of play are for SRTs and US regional banks, and whether we are kind of in a transition periods where they're more appealing now than they were before. So yeah, maybe David, you can delve into that question for us.
I would say that they're more appealing from the perspective of spreads are significantly tighter. So the broad adoption started in the end of 2020, in September of 2023. And over that time period, spreads have come in, they've pretty much cut in half from where they were to start. I think on top of that, the docs have become much more standardized. So the time to bring a deal to market has become much faster. The number of investors that can do a trade. So about 85% of the trades are SPV style trades, where a client sets up their own SPV. We like to call it BYO SPV, like BYOB, but BYO SPV. You bring your own SPV. And the amount of clients that have that infrastructure in place today versus a year and a half ago has dramatically increased, which has improved liquidity and brought in spreads. And then 15% of the trades are CLN format, bank CLN. So these are actually issued out of the bank itself. And where we've seen there is we see it started predominantly in autos, but now we've seen that issued as well in corporates. So the amount of rated notes that are sold in an SRT form has also increased, and so that has sort of proliferated increased activity, which I think, to answer your question directly, has made it more attractive for banks to come in purely from a cost of capital perspective.
Have there been noticeably kind of a flow of new entrants? Like, is that how you would characterize maybe the last year and a half because of what you described?
So I think issuance is up 30% year over year, but it may feel disappointing just because the Bloomberg and news cycle has definitely slowed down. There was a period where there was an SRT article every day, every week, as it captured investors' imagination because it was the intersection of private credit and bank deleveraging. And so there was definitely a period where there was a lot more focus on trades, but so I think that has subsided, but issuance has steadily increased. I think usually clients that do one trade will end up doing 5. So it takes a while for a bank to do their first trade. We talk about their readiness to do one, but once they do one, they usually find it quite effective, and we see repeats. So to answer your question, we do see new entrants, but what we do see more often is just existing entrants doing more trades across increased variety of collateral.
That makes sense. And then I guess, from kind of the bank's perspective, this question is for you, Darren. What are kind of the reasons to do an SRT as a regional bank? Like some of the different pillars that Gareth started to allude to, but maybe you can expand a little bit on kind of, why you might do it and why it's helpful for balance sheet management.
Sure. And I think the first point to make in this is that this is very much an offensive arrow in the quiver of banks and should be looked at that way, as opposed to a defensive one where you're short on capital or need to, get smaller or whatever it is. Like, we use this, and I know a number of other regional banks have used this as a tool of growth for our balance sheets and for our firms and our ability to service our clients, not as not the way in which you go back a few years to that regional banking crisis where, oh my God, I'm short, got to find a way to to deleverage, to how David had mentioned. I think that's just a very important distinction, both for any banks looking to get into it, but also for investors kind of working with new banks coming into it, that it's not a distressed play. It's a forward-looking offensive one. From that perspective, I think Gareth covered a lot of it. Capital relief, balance sheet optimization are really the key elements of it. Again, it's just another tool alongside selling assets outright or raising equity or participating loans, things of that nature. It's just another tool you can use from the bank balance sheet, corporate treasury standpoint, to sort of manage your portfolio growth in the optimal fashion. I think other aspects of it that are important, certainly to us, is being able to manage concentration limits, especially from our case, being a $20 billion bank, to individual sponsors. We want to be able to lend and keep lending to our best clients. Sometimes we run into limits, based on our capital size and balance sheet in terms of what we can do. It also gets a little bit more nuanced, but there's the ability, depending on how you structure it, to also reduce concentration limits on product types, which can be useful to a lot of banks out there. And then the final aspect I'll mention of it is, again, you're getting this capital relief, this regulatory relief from it, because it is a hedging tool. You are getting rid of the lowest or the most risky portion of the loans that you are referencing. And for that, for that capital relief, you're doing it by way of reducing risk tolerance. That may not always be the motivation for banks doing it, but it is obviously a useful byproduct. Now, we tend to do this off of, all banks tend to do this off of cleaner assets. They're easier to place, but having that hedging component can come into play down the road, and can be a useful tool as well.
Is there something about SRT that, you get an additional benefit compared to some of the other balance sheet management tools you might use to achieve kind of what you described?
So I think, Gareth kind of pointed to this a little bit. It is a tool, since the loans themselves are certainly in the synthetic approach, are staying on your balance sheet. It's that maintaining that control and direct relationship with your clients, as opposed to selling those assets to someone else, or even selling them into an SPV that essentially a B-piece investor would largely control. You also then have those loans accessible for other uses. They can be pledged if you want to ultimately then take a loan you've referenced in an SRT and ultimately sell it down the road or sell a portfolio. You still have the flexibility to do that. So really, keeping the loans on your balance sheet gives you a little bit more control over them going forward than outright sales or other securitization approaches.
Maybe going back to Gareth in terms of the regulatory backdrop for this, of course, there are certain drivers, which I think we've alluded to in terms of concentration limits, or maybe be it like capital regulations, but how do you sort of see the current regulatory backdrop? Is it fostering more SRTs? Does it complicate things?
I think that the key thing that you need in any regulatory instrument is certainty, right? You need to know that you are going to achieve the outcome that you are looking for and that it is going to endure over the life of the transaction. So that was why, for example, a year ago, 2 years ago, there was still some uncertainty in the market because the Basel III endgame was in play. That did have a couple of provisions that sort of touched on credit risk transfer transactions in a slightly unhelpful way. It would only have directly affected the very largest banks, so fewer than 50 out of the 4,100 banks in the United States. But just that noise was unhelpful. It was just a set of an element of uncertainty that kind of was unsettling within the market. That's now largely gone away. We are expecting another reproposal from the Federal Reserve probably beginning next year, and that may well still touch on credit risk transfer. But I think that there is some optimism in the market that it's going to do so in a somewhat more benign way. There are really just a couple of things in the current framework that we would like to see optimized. Otherwise, it is certainly fair to say, I think, that we know what the current rules are and you can execute transactions under them and you kind of, you know where you are, at least for a sort of shorter duration transaction. Nobody wants to do anything at the moment with a super long duration because of the sort of the question around whether the rules are going to change. But the only things that we are hoping for now are possibly rules to assist banks to do direct issued CLNs in a more straightforward way. Possibly reductions to there's a credit adjustment factor which might allow us to sort of shrink tranches down to sort of more of a European thickness. But otherwise, if nobody touches the rules, I think the market would probably be okay. We know how to execute, and deals are getting done on the basis of the current rules.
And if I may, I think what's also important in the regulatory aspect is the fact that just the signal that actually regulators are not against this type of transaction. Because until a few years ago, there was always a bit of a doubt or an uncertainty around, is the Fed really supportive? Am I going to spend a lot of time as a bank to try to develop a platform and somehow my regulator is going to be extremely painful with me or kind of like kill any capital relief or any type of relief I'm looking for? And some of the regulatory clarification we got over the last 2 years or so in the US have been particularly helpful to kind of like kill a little bit that element around making sure that actually it is okay to do this trade as long as you do them in the right way. Now, sometimes the challenge is, as you know, you have a kind of like almost like regulator by state, or I would say like the local Fed by state. And while the New York Fed is obviously very familiar with this type of transaction, you have sometimes in different states like different type of discussion. But fundamentally, the important fact remain, in my view, that there is, I wouldn't call it support, but there is kind of like an understanding that these trades are actually helpful to the banking industry. And it's very important because to come back to Darren's point around what's the reason to do SRT, this trade takes so much time to put together that you need to invest a lot of time to educate people internally. You need to build the regulatory frameworks, the reporting, and so on. And it's very important to make sure you're not doing that for no reason, and you actually know that, okay, you're spending a lot of time, you're doing a lot of work, but ultimately you're going to be rewarded with, the capital saving or the risk saving or whatever that is that you are looking for.
And just before we move on, I wanted to ask David, is there anything else to add maybe about like a regulatory push that would preference other kind of options beyond SRT?
I would say no. I think that when it relates to options away from SRT, the easiest way to reduce capital is usually just to sell assets. So I would say that the rate rally that we've seen over the past few months has increased the dollar price on a variety of different asset classes, which makes the value proposition of SRT diminish. Granted, that's for assets that are easily sold. As Darren correctly mentioned, some assets banks do not want to sell or can't really sell very easily, like say subscription finance or some corporate revolvers. But for assets like auto loans or even mortgage loans, when we weigh the pros and cons of an SRT versus a cash securitization versus a full securitization, which we've defined where you sell the residual, or just a whole loan sale, we think that in today's environment, whole loan sales look really good for banks. And so what we do is we sort of show the different options for them, and that's less regulatory, more interest rates. But that would be my answer, Celeste.
Makes sense. And maybe going to Liz, in terms of the experience that you've had, working with regional and community banks, how do you get a sense of this kind of multifaceted, somewhat holistic approach that you take when you're determining whether it is SRT that you want to use or when it might make sense to use some of the other options we've talked about?
Yeah, I think what I would start off by saying is walking into any bank and getting on a phone with the management team and telling them, hey, you should do this, is not the right way to approach this. It is more of a conversation around, understanding what their balance sheet looks like, understanding what their needs are, and having a discussion around what we think makes the most sense. And we really started, I'd say, pounding the pavement in 2019. And when you walked in and said you should consider a CRT transaction or an SRT transaction, nobody really wanted to hear about that. You fast forward through sort of what happened in the market in 2023, and you had a bit of a shutdown in capital markets across the board for banking institutions. And that conversation started to take shape a little bit more, also given some of the regulatory clarity that came out in 2023. It was a bit of a different conversation. At the same time, sub-debt markets were largely closed off for a lot of these institutions. So capital for capital's sake, it's more of a discussion around, does it make sense for you to be issuing sub-debt? Does it make sense for you to be issuing equity? What does that look like? What's the cost there? And then that conversation really morphs into, what is the subsect of your loan book that you're really looking to do something with, and why? What's really the reasoning behind it? And that's where it starts to evolve more into a conversation around, is it RWA relief on that subsect? Are you looking for some relief in CRE concentration? Do you really want a true sale of these loans, or do you not? And for various reasons and mark-to-market purposes. When you're looking at institutions that are on the smaller end of the spectrum too, for some of them, trying to sell a portfolio of loans into an SPV and take back a security dramatically sort of shifts the way their balance sheet looks. Does it make sense for them to take back some of this exposure in loan format versus security format? I joked about the alphabet soup early on, but I do really think that that's an important point. At the end of the day, understanding that what a bank is ultimately looking to do, I think, through any of these transactions and in any of the forms that they take, is what they do best. And that's really maintaining customer relationships, the ability to retain servicing there and keep that, that customer facing relationship, we think is important. So I think taking a more holistic approach, which is really, I think, part of our background and what we do, and we do invest across the stack through various entities that we manage. Sometimes we'll walk in there and start to have a conversation around, hey, maybe sub-debt makes sense for you, but wait, now we've understanding what some of your other problems are, and maybe this is just another tool in the toolbox that you should consider. So I think it's different points in time. It's shifting market dynamics. It's a conversation about what they want to do looking forward. To Darren's point, we really think that this is a growth tool, and there's a lot of applicability there for how they want to kind of grow either certain portions of their loan portfolio or how they want to handle risk management for larger relationships, especially in industries where you have consolidation and the loans that they're looking for from single entities start to become larger, and you don't want to look to try and syndicate that exposure out to your competitor or neighbor banks. So, I don't want to just keep repeating the same point, but making sure this is a balance sheet management tool at the end of the day is what we think is the most important, and looking for partners that have an incentive alignment in what we're looking to do and what they're looking to do.
I'm not sure if anyone has kind of further thoughts on the sort of, different tools, maybe Frank.
Yeah, no, I think what has been said is correct. I think it all comes down effectively to what is it that the bank want to achieve, right? I think that needs to be the starting point. It's like no one's saying you should just use SRT no matter what. But one of the things that I think is very clear in my mind is that very often some of these tools like SRT take a lot of time to put together. So you cannot do, for example, an SRT transaction when you really need it immediately within a month or so. I think everyone would say, the first transaction would take you 9 months, maybe 12 months. And so you also have to think of it as, it's not great now, it's also a tool that is helpful when there is a period of crisis. So when COVID hit, for example, a number of transactions happened, but that's not at that time you need to set up your program because it's too late. And so my personal view has always been that any bank should have a program of SRT or securitization in general, even if it's not used that much, even if it's a small size, but just to have the pipes, the governance, the kind of like touch point with investor, so that when it needs to do a bigger size, particularly if there is a period of stress or a different time, that is actually kind of like very, very important. The other point I would flag in terms of like the choice of assets sometimes is there is an accounting consideration. So SRT is quite relevant for, sometimes people confuse the S with synthetic. It's meant to be therefore significant, but it is true that most SRT are synthetic. And one of the benefits is that you don't have to transfer the asset. And as a result, you don't have to derecognize the asset from an accounting point of view. And that was very valid, when interest rate changed, for example, and various banks were using synthetic technique because they just didn't want to do like a pure sell and take some sort of mark-to-market hit, right? And so that is, a very relevant point, which is the tool that the bank will use, maybe, for example, outright sell now, because it makes a lot of sense, portfolio sell, but tomorrow they might decide on the exact same portfolio to do a synthetic trade, just because of some of the reasons I mentioned, or what kind of like David was also mentioning around the fact that just some assets you just cannot transfer. If you're trying to do something on, say, revolving credit facility, you're locked, you're not allowed to sell them. So that's important. The last thing I would say is sometimes when people think about other options, they also get a little bit confused around, capital product like AT1 or things like that. This is a very different tool. Here we're talking about hedging techniques. And from that hedging, you derive the capital benefit. The other tools sometimes are pure capital plays. They have nothing to do with assets. They are more binary, so either you get paid or you don't get paid. Here, you're really kind of like exposed to the performance of the asset. So I would put them in two different categories.
To try to combine Elizabeth and Frank's points and to mention it slightly differently is the primary motivation for banks to do these trades has changed. 2023, capital relief. 2024, proof of concept. 2025, capital efficiency. These banks that are doing trades today often don't need the capital. They're just trying to view this from a pure return on capital, return on equity perspective. And that's, I think, what's 2025.
Having the motivations change, does that, I guess, maybe change the way that it's executed or the kind of conversations you might have with investors? Like now, obviously, has been that proof of concept, but if the aim is more for capital efficiency, I wonder if that kind of changes anything.
I would say it changes the collateral mix.
Yeah, I'd agree with that, because if you want effectively to kind of like optimize for capital, you might come up with, or for return on equity, as David was saying, you might come up with an investment grade portfolio where you get a very low price, and somehow that works very well. But if you're focused on like concentration limits, you might go in same portfolio, but not investment grade. You'll go like on the high yield, on the more risky part of the book. So the asset class may not change, but the asset you're going to select is different, which also lead to another point, which is when you use a portfolio that is not fundamentally a representation across the board of the lending of the bank, but a specific subset, but that the bank continue to manage the kind of like the asset, then you need to understand as investor, I know we'll talk about it a bit later, but you need to understand and be very mindful of that, because that motivation will drive a different portfolio selection, which might drive some different behavior as well that investor will need to understand.
Yeah, that makes sense. And just before we get into that, I know we've alluded a fair amount to like kind of concentration limit based trades. So maybe we can just delve a little bit more into that example for CRE concentration. Liz, maybe you can talk us through like just like a more concrete example of what that looks like. Like maybe it wouldn't exactly count as the strict SR, like traditional SRT that we think of, but it's still, touches on some of the points that we've been discussing.
Yeah, I mean, I think it's no surprise you pick up a newspaper and you know that the regulators are hyper focused on CRE concentration within the banking sector. And so that is where I think conversations have managed to take hold with a number of banking institutions. Looking at that, more specifically, where it sort of tends to lend itself to an interesting transaction, really, right now, it's in the multifamily space. That is CRE bucketed assets. But looking at that this is really an efficiency tool and an optimization tool, what's going to be your cheapest form of capital in the form of a DRT or an SRT there. And really it's starting to boil down to the accounting considerations of looking to have that true sale of the asset off the books or whether or not you want to retain it. I think you also see it in other sectors of commercial real estate. I don't think you're about to see a ton of transactions happening in office right now. I don't think the market's there. But I do think that it lends itself to an interesting tool for banks that are looking to continue doing what they do best. And it really boils down to, for us, again, incentive alignment. Is this a tool to allow them to keep writing a business that they've wrote for a long period of time and to continue doing it well? And if so, does this make sense for them from a cost perspective and from a time perspective? To Frank's point, it is a lot of internal buy-in for a bank. It's an education process internally. It's an education process with the board. Does it make sense for them to do this? And these are all considerations and conversations. And it's not unusual for us to start having a conversation on one subsect of a loan book with an institution and then rapidly finding that that's shifted completely into an entirely different conversation in the process. And I think that especially for your sub 100 billion in assets, sub 50 billion in asset banks, the ability to be agile and to have that conversation and understand what it is and how that dynamic's shifting as the transaction starts to evolve and be able to pivot, that becomes a little bit more of the challenge and really informs where you end up in the long run.
Makes sense. Darren, I did want to ask you for some other kind of examples as well of SRTs where maybe in the more strict sense of the definition, where it can be quite useful to do this type of transaction. So I think there are some peculiar, like, shall we say, balance sheet issues, specific assets, which might lend themselves well to this. We've discussed them a bit. I know there's been a transaction involving balance sheet bridge financings with an expected takeout. This is kind of an interesting scenario where you can use SRT. So maybe you could just explain that a little bit for us.
Sure. And actually, just to hit on one of Elizabeth's points from a second ago, I think not just sort of looking upward in terms of your bank and getting board approval and buy-in, but really understanding how your own infrastructure is capable of doing this, because it does touch a lot of different points in your bank. Normally, I'm sure most of Elizabeth's conversations probably start at a corporate treasurer or a CFO level. That person has probably got quite a lot to do anyway, as the idea of a transaction filters through your data analytics teams, who's putting together that tape to do it in the first place, what happens once it's finally closed, and how do you do the reporting so that investors like Frank and Elizabeth, who are going to want information post-close and want to make sure they're getting accurate reporting and consistent reporting, can get that. So I think, we were fortunate at Merchants that we had a dedicated capital markets team whose job it was to figure this stuff out even before we started doing SRT. For those regional banks that are really not set up that way, like, that's who manages this? Who are the stakeholders internally? I think that's an important kind of consideration for the banks and even the investors, going through the work to kind of do the R&D on this is, are you really set up with the pipes, infrastructure, and people to facilitate it? But to your point, like, in terms of what assets kind of work here, what we have done a lot of is, what a core part of our business is at Merchants is bridge loans, short-term, generally 2 to 4 year term loans with an expected agency takeout. So we do a lot of multifamily and healthcare. That's our core asset, where our loans are, the end result of our loans is a takeout from Fannie Mae, Freddie Mac, or HUD. So doing this in an SRT format fits well for a couple of reasons. One, we want to keep control of those assets because we're facilitating the move from that bridge loan to that permanent exit where they go to Fannie, Freddie, and HUD. That's not only a revenue driver for our bank, but it's a solution for our clients. That's where they want to get to. And so we're facilitating that for them. So I think that's important in terms of being able to manage those assets and not having them sort of transition away from us through, in a way that a direct sale or a true sale in a securitization might affect us. The other part of it that's useful for us, given our short duration assets, is something Gareth alluded to earlier on, which is just regulatory changes. If you're doing this even on residential mortgage securities, which are 20 and 30 year loans, changes, you're kind of stuck in these trades. One of the things the regulators won't let you do is capital call, regulatory capital call. So in other words, if they change the rules, that is not a reason to be able to call the transaction. You can do cleanup calls generally if the deal is less than 10% of its original balance, something like that. But if your regulators change the rules, that's not a reason. So depending on the term of your assets and the term of your trade, you could be stuck for quite a bit of time. And if they change the rules on you, you're no longer getting that capital treatment. So for us, staying in shorter term assets gives us a lot of comfort that even if they do change the rules, there's probably a long period. You've got a lot of runway before it's going to happen. Most likely our transaction has paid off by the time that has come through. So we're not nearly as exposed to that type of risk.
I would say Darren is correct, but at the...
Sorry.
No, it's okay. Go ahead, Frank.
No, just making a joke that luckily regulators are not always the fastest to make a change. So I guess sometimes it plays in your favor as well to reduce that risk. Sorry, David.
I was going to say that while you're correct about residential loans, Darren, I think we don't see a lot of SRT for resi loans anyway, because what lends itself best to SRT across the board is low loss, high capital, and resi loans are low loss, low capital, so they're 50% risk weight. So an auto pool, just one for one, is going to have double the capital when you compare it apples to apples. And so I also, furthermore, the residential whole loan market is so robust and deep that there's a lot of other ways to sell and move out of residential risk. But your point is correct, but I wouldn't bash on resi SRT as much as you did.
Fair enough. The question I wanted to sort of loop back to as well, especially when we're thinking about this more specific underlying assets in these trades, what kind of is the state of play for investors, given that still regional banks are quite diverse, as Liz discussed, but also, Frank, you alluded to potentially different kinds of underlying assets, that some may be higher risk. So yeah, Frank, maybe you can sort of give us your views on the investor perspective.
Yeah, I mean, I think, look, the first thing that at least is very noticeable as an investor is historically SRT has been kind of like originally done by large bank with different type of portfolio. So you'll go to one of the GC or large bank, and then you'll have a choice of one time they might do like a corporate loan trade, the other time like a mortgage, and another time an auto, and so on. What is very clear is obviously regional banks tend to be extremely focused, right? So they very rarely, if not, kind of like have a lot of different type of lending activity. And so the first element is that in my mind, most of the regional banks are very specialized in a few asset class only. And so you have to kind of like pick your poison depending on, as investor, what type of asset class you like. The other thing that I think is worth noting, for regional bank is the fact that because these transactions, to the point we were making earlier, are, relatively kind of like take time, are complex to put together. Generally, you want to do them because you have a certain size, a certain portfolio size. And despite the fact that I think you have more than like 2,000 regional banks, not all the regional banks have a balance sheet that may be big enough, to do some of these transactions. Typically, the expectation would be for, an SRT to have a portfolio at the very least of like at the bare minimum 500 million, 800 or 700 million to kind of like include in the transaction, because once you tranched it, you need to be big enough, and that only comes after you've applied all the eligibility criteria, portfolio test, etc. So you need to start from a relatively decent size type of balance sheet to do that. And so unsurprisingly, SRT has been, as a result, more of a focus for like probably larger regional banks than the smaller ones, right? So far for question of maybe education, but also, availability of the asset and whether that the effort would be justified in relation to the size of the balance sheet. And particularly, as was alluding to the fact that most of the regional banks are generally focused on certain asset classes. They're also generally very focused on their own state, right? So you also have to take that fact into account. And so if I was to compare, what you'd see SRT of kind of like GC versus regional bank is that in GC, you can have multiple asset classes, not obviously in the same trade, but also they can be quite a global activity. Obviously, regional, you'd be very focused US, but actually certain states only, a certain asset class only, which, some of them were mentioned, whether it's kind of like auto or mortgage or bridge loan or CRE, right? So that's definitely something we've seen. I think, maybe one last thing is as investor, it's also sometime for us, there is a question around picking our battle around who we're going to contact. Just because, as we're saying, when you have like more than 2,000 regional banks, we obviously cannot call everyone, right? And we cannot spend the time with everyone. And so there is an element around kind of like effectively reaching out and targeting the institutions that are more open for now to do this transaction, but also this type of asset class. Now, they are, I think very helpfully, you have large DC US banks that also try to help them and where we can, come in addition. And I think that's also, a potentially kind of like important fact pattern for a number of regional banks that needed to receive, kind of like a bit of help, whether on the advisory side, on placement side, and make a kind of like helpful junction with investor like ourselves. The CRE point, I think, is very interesting because obviously, to exactly the point I was mentioning earlier, is CRE is quite adequate for SRT because you don't have to sell them at potentially a huge discount. So for a number of regional banks, they've been looking at it, and that makes sense. But because of the pressure you may have, say, on offices, etc., as I think Liz was mentioning, you need to be targeted as a regional bank to kind of like select the right asset and the asset that will make more sense, where you get the best price for your capital play. And that's what we as investors, for example, we look for too.
Liz, I don't know if there's anything you wanted to add, maybe from the investor perspective in terms of what's needed to succeed, and actually to add one point from the questions that are coming in, maybe also some of the potential risks for the investor to think about when like going into these transactions.
Yeah, I think as far as to succeed and really to understand the asset class, the ability to be agile and to really be understanding of what a bank management team is looking to do, they're fundamentally, I think, two of the most important things. And the reason I say the agility there is, as I mentioned, conversation can start one way, and 3 months later, you're having a completely different conversation. And up until the 11th hour right before you close on the securitization, you have to have the flexibility when negotiating these bespoke transactions to sort of block and tackle any issues that come up as they arise. Because we are financial investors and have been, through the course of our entire existence at EJF, I think looking to pair with a partner, with a bank that we have a track record with, someone that we've either been invested on the equity side of things, we have done sub-debt for them. We are a very large purchaser of sub-debt, have an entire securitization platform dedicated to that. So there's familiarity with the space. There's a track record there. We were one of the largest purchasers of TARP coming out of the crisis, and managed to make a lot of inroads with bank institutions, having conversations around, look, this is an inefficient form of capital for you. Doesn't make sense for it to leave it outstanding. So having conversations with teams that we know, that have track records that we know in areas that we have familiarity with, and really on a loan portfolio that we've looked at the entire portfolio, we've decided, this is what we think makes the most sense, both from the bank's perspective, from a cost standpoint, and from our perspective and our end investors' perspective. It's a multifaceted approach to really what I think makes it successful for us. The other thing is, we don't shy away from small transactions, and if it's an issuer that we think is only really going to do a one and done, that still works for us. It is a time-consuming trade, and I think you find that some other participants in this area are looking to deploy large amounts of capital very quickly into maybe the same type of SRT or DRT. We are looking across a number of institutions, and the goal is to really just grow the market across the board. And so to Frank's point, you have 2,000 plus smaller institutions in the United States. We won't shy away from someone that we think is just going to be a one and done, and then go to the guy next door and say, hey, does this make sense for you? You know, we have done transactions on pools as small as 150 million in assets. So I do think that there's more applicability there. It's just a matter of patience and agility, really, in dealing with some of the smaller guys and being mindful of what they're ultimately looking to do.
I'll add there, you know, from a bank's perspective, one of the things we want to see from investors for them to succeed in working with us is expertise in our asset classes. You know, we've been fortunate to work with, you know, a number of investors in our transactions, and they all understand our collateral, which is super helpful. We've had incoming, you know, calls from firms that want to work with us. Experts in SRT tell us about all the European deals they've been a part of. We ask them about, you know, what their infrastructure is to underwrite commercial real estate, or in our case, specifically healthcare, which is a niche asset class. And they tell us they have one person and did $30 million worth of, you know, a distressed hotel purchase last year. And for us, that presents a risk of ability to close. Like, we're not trying to take anyone or just get the tightest yield from someone who just wants to throw money at us and do the trade. We want to know you can close. And part of that is understanding the asset class. And also, if you're in an area that is not the most on the run asset class, like commercial real estate, where it's a little bit bespoke, we have certain terms that we want in order to be able to maintain the relationships and do the things we need to do with our borrowers to facilitate their exit from loans. And so we want that flexibility built in, and investors that understand that are happy to give it to us because they know it's in their best interest as well, versus having very rigid structures. So I think that's really important from an investor perspective when you're going to banks, is understand their product.
I do think that sorry, let's go ahead.
I was going to say, I would just add to that. Yeah, I mean, at the end of the day, our job is not to question your underwriting. If I'm at the point where I'm questioning your underwriting, why am I looking at the portfolio in the first place? And so to Darren's point, I think you really want to be aligned in that you do have a partner that, while they're underwriting it and they have the expertise to underwrite it, they're not there to give you a hard time ultimately along the way, and that they're really motivated to get to the finish line.
I mean, this dialogue sort of reflects what we always say about CRT, which is that it is the archetypal relationship transaction, right? The investor is buying in because they understand the bank and the bank and the bank's servicing and underwriting, and the bank is partnering with the investor because they have confidence in that understanding, and the fact that, you know, if things happen within the portfolio, that is going to be addressed and analyzed in good faith and on the basis of a sort of real understanding that, you know, things happen within portfolios, and it's not and it's being managed responsibly and carefully by the bank in that sort of consistent way. And so one of the things that, you know, is quite striking in these transactions is like, you know, the servicing standard definition is basically the bank's going to do what the bank's always done. And if you don't have that fundamental confidence and understanding of what the bank has always done, then the transaction is, you know, really being built on a fairly unsteady platform. And, you know, the banks understand the merit of that in their investors just as much as the seasoned investors understand the importance of that real diligence on the bank and the bank systems.
Well, that makes sense. And I did just want to get the chance to ask David about how potentially kind of that third-party role slots into this dynamic that we're describing. I think it's a bit more well established. We see this with some of the smaller European banks. So yeah, I just wonder kind of how that experience has been, and yeah, sort of what you see there.
Yeah, so Darren's example is maybe an exception, not the norm, and just his product is clearly specialized. I think our role as intermediaries is not dissimilar from what we do on the ABS, RMBS side, where we run deals, we run processes, we bring in, if it's a consumer deal, we have consumer bankers that have expertise in the collateral. If it's a corporate deal, we have our CLO team, our IG team that are reviewing the collateral. And so we just bring a lot of resources to the trade because these trades take a lot of time, and we bring dozens, if not more, experts to the table. And then on top of that, we try to standardize it. And so I think your previous question was, what's the state of play for investors? State of play is it's hyper competitive. Spreads are tight, not just in SRT, but in everything. And the amount of capital looking for private assets, which this usually falls into that bucket, has never been higher. And so what we try to do is we try to be the intermediary between the investor base and the bank. But today it's definitely a seller's market. And so we try to help banks achieve what they're trying to do and really think about building long-term programs and to find that those right investors. And so whether it's a vanilla asset type or a special project type asset, I joke every SRT trade is either a science project or a fire drill. There's nothing in between. We have helped banks sort of hit their timing targets for quarter end, as well as certain return on capital targets.
Yeah, to David's point, I think the best assets to do this with are the most homogeneous, well understood. I kind of joke, if you can do the whole analysis on a spreadsheet, that's the best asset to go with, because I think that, to his point, that makes that you can syndicate it, a lot more competition for the bank from investors, get that yield down, go with the easiest, cleanest stuff first if you have those opportunities as a bank.
But I think to be beyond that, I would just add that I think the best assets often are ones that can end up in a rated format. And so sort of just the market will move towards creating investment grade risk out of these bonds, or out of this risk. And we think about the Fannie Freddie CRT market and the transition that went through from corporate obligations of the GSEs to credit linked notes to just REMIC bonds, and think that SRT could sort of broadly follow a similar path to increase liquidity, increase ratings, and just becomes a normal option for banks. One day they do a corporate bond, the next day they do an ABS, and the next day they do an SRT. And this is sort of maybe the long-term steady state. We're still not there yet, but that's where we may end up.
I did want to get the chance to look at some of our questions. I'm not sure we'll get to all of them, but we can respond in due course. One question is, actually, I've heard it debated a bit, so I'm curious to know kind of the opinions of the speakers is, what role SRT might play for a potential wave of M&A. I know that if you, want to do an SRT and then immediately after do an M&A, that may not have been what the investors signed up for, because obviously you have to manage the SRT throughout its life cycle, and you're signing up for a certain bank's kind of infrastructure. So I wonder, your thoughts on the sort of potential for more M&A. Like, is SRT like a tool for that, or just your general thoughts on that?
If I may, I think we had a bit of an example of that actually. There was a wave of SRT in Canada, which was, I think, kind of like a year to 2 years ago, because there was a number of M&A activity in Canada, particularly kind of like around acquiring some US regional banks. And so we had a bit of an example. So the short answer is yes, that is a tool for M&A, but it's rarely a tool that is embedded with the M&A. It is more like it's more to clean the balance sheet ahead of the M&A that the SRT is being considered, but it's almost like as part of the general exercise of the bank to kind of like clean and make everything tidy and improve some of the ratios, etc., to prepare the M&A. It, at least from my standpoint, I've never seen kind of like an M&A where the SRT is part of the M&A strategy and where it's kind of like all planified. It seems like it can work alongside, but it's just like they have different ways of working, they have different timing, etc. So lining up the two exactly seems quite a bit of a difficult exercise.
I would just add that, the phrase tool in the toolkit has probably been used 7 times on this call. And I think once banks have done these trades and once they have the wherewithal and the pipes to do them, I think there are creative ways to use this technology for both as the banks looking to acquire other banks and look at their portfolio as well as their own to increase capital. And there's different ways you can increase capital, but this is absolutely one of those ways.
I think that's true, although it goes, it does come back to that point around familiarity and infrastructure, because there are obviously there's that initial investment that any banks that are doing the SRT have to do. And if you're the acquiring bank and you've done this, then obviously what you're doing is really just increasing the portfolio of assets that you might be able to sort of, to do the transactions on. If, on the other hand, the acquiring bank and the bank that sort of, kind of assumes that it's probably going to be the one that sort of maintaining its own accounting, financial reporting infrastructure, that sort of thing, is buying a bank that's got the transactions out there, it adds that additional element of sort of complexity, So, are you an axe lumberjack or a chainsaw lumberjack? Because those two things, are not necessarily the same, the same sort of way of approaching the issue. So we have seen some cases of, there have been sort of bank mergers where they've sort of looked at the SRTs that have been in the portfolio and sort of decided that that's just not the path they want to go down, and chosen not to pursue it. But I certainly agree with the sentiment that people are not doing SRT transactions in the expectation that they are preparedness for any of the sort of the coming wave of bank mergers. I don't think it's that sort of tool.
And we might be pushing it a little bit on time, but this does sort of tie into what we're discussing. So I do want to ask this last question to Darren, which is, obviously we talked a lot about, doing the trade, but once the SRT is live, what adjustments do you have to make, from an organizational perspective, the infrastructure to kind of manage that SRT? Maybe just, kind of brief overview of what that looks like.
Sure. So as a plug for additional demand for people in my role, like having a capital markets team or someone dedicated to sort of being that center point for all the touch points within your firm that have to be involved here, from obviously your corporate finance, accounting, servicing and asset management, if you have that internally, or those external providers, the relationship managers who, loan officers involved with these deals, all those players stay involved post securitization. Then you also need to have that interaction now with your partner, your investor partner. So kind of centering all of that around a team or a group of people, I think is key. Because I think, one of the big points here is, and I've said this in the past, like the transaction really begins when you execute the confirm. Then you have, years of cooperation with your investor partner as well as with your, borrowing clients, and making sure that's as seamless as possible for both parties. For you as a bank is just, it's critical to be able to, kind of keep this as a tool in your toolbox, to use that, hopefully be the last one to use that term. Because if you can't manage that, then it's no longer really a viable product for you.
Yeah, no, that makes sense. Well, listen, thank you to all our speakers for joining. Really appreciate it. That was a very interesting discussion. Like I mentioned, if you haven't signed up for the conference itself in New York on October 6th, held by DealCatalyst, we'll circulate some information to sign up and discounts after the webinar. Thank you very much, everyone, for joining.